Hi everybody, this is your professor and I'm going to make a video today of chapter 2. If you like these, then I'll do another one or 2 or 11 in the next coming week. So if you find this valuable, then let me know and I'll do some more. Okay, so what do we have here? We learned in the last chapter that we have this accounting equation, which is assets equals liabilities plus, wait for it, that's right, owner's equity. So I'm going to give you a little flash quiz here and see if you remembered chapter 1. So if I am ExxonMobil and I have total assets of $228 billion, so that's going to go down over here, and then I have total liabilities of 107, then what's missing? So then I've got to figure out what my owner's equity is over here. So I'm going to do some math. If I have 228 over here, that means I've got to have this side come up to $228 billion. So I take the 107 and I realize that I've got what's missing is my owner's equity for 121. That's as simple as that gets. So anyway, my assets, my left-hand side, which is what I own, those are my assets, whether it be, property, plant, equipment, cash, receivables, that kind of thing, things that are valuable to me. And on the right-hand side, I have what I owe for those assets, or what's a claim to those assets in terms of owner's equity. So hopefully that makes sense. Okay, so, sorry, I had to go through that again. Let's take a look at Amazon. So Amazon has $4.7 billion in assets, lucky them, and they have owner's equity of $300 billion. So what's missing? What's going on over here? Okay, so my accounting equation tells me that's my liability. So if I put 4.7 billion over here, 3.0 billion over here, what's missing are my liabilities to make this whole thing balance of 1.7. Okay, so I've got another one for you. All right, so what are we trying to do here with financial accounting? We're trying to measure and record the transactions. So every single thing that the company does that have any financial aspect will affect that accounting equation. So we're trying to measure those things as financial accountants and then communicate those overall financial statements that we create to outside investors or for other people that are trying to make decisions about our company, investors, creditors, customers, that kind of thing. Okay, so those are the major aspects of why we're doing all this, in case you were curious. Okay, so here's our accounting equation over here. Again, we have our assets on the left, our liabilities and stockholders' equity on the right. So every equation that we do in this company will have an effect on this accounting equation, and it will always, if we record the transaction correctly, it will always maintain a balance for this accounting equation. Okay, so if total assets go up, then either total liabilities or stockholders' equity increase, although it could be that our assets go up and our assets go down at the same time. So let me give you an example. Let's say we buy a piece of equipment for $75,000 in cash. So in this case, our equipment account, which is an asset, would you agree? Yes, that will go up. And then my cash, because I just told you I paid cash for it, my cash will go down. So far I've upped my assets, equipment, and I've decreased my assets, cash. And so this and the accounting equation will still equal at the end of the day. So that's pretty neat, huh? All right, so for each transaction, each financial transaction that occurs in a company, ask yourself, what account is affected? What's the other account that's affected? And do they go up or do they go down? And does it balance? Because it always has to balance. All right, so expanding this accounting equation, we have a couple of things under the stockholders' equity that I'm going to take a little deeper dive. So under the stockholders' equity, which is really what the owners of the company have their claim to, we have common stock, just like you may have some common stock that you own in the stock market, and then we have some retained earnings. Now retained earnings, I'll get into a little bit further. Retained earnings are really just the revenue, which is our sales that we make, less the expenses that it took me to make those sales, less any dividends we pay out to our stockholders, and all of that equals and will result in whatever the end number is for that. So I'm going to make some sales. I'm going to pay some expenses, whether it be the cost of the goods that I manufactured to sell, or the cost that it took me to get them from somebody else to sell to my customer, or the payroll that I had to pay. There's lots of different expenses, which we'll get into. Just take for a moment that it's expenses, and then we subtract the dividends. Then all of that gets rolled up. We come up with a final number, and that comes up into our retained earnings. So that's why we call this, it's expanded, because these things are down here, but eventually they get rolled up. So they get rolled up into retained earnings, then we take into account our common stock, and then that finally rolls back up to stockholders' equity. This is kind of a neat little graphic of how you're going to deal with things. So I call this a T account because, oh, it looks like a T, that's why. Okay, and one of the things about our T accounts, which is getting back to our transactions when we record those, remember how I told you they always have to be in balance, so they always go up or they go down. So this is kind of a neat little thing to say, okay, so my T accounts, how do I increase them? And the debits are on the left and the credits are on the right. And so you'll come back to this, but I'm going to So this is from Connect. So I kind of take a pause here and I say, all right, let's go to brief exercise 2.6, and we're going to understand the effect of debits and credits. So the balance of an asset account increases with, all right, so now if you come back over here, you can see, how did I increase my assets? I increased them with a debit. That's right. Okay, so the balance of an asset account increases with a debit and decreases with a credit. Okay, the balance of a liability increases with a, and then you'd come back over here or over here, it increases with a credit and decreases with a debit. Okay, now this is not something you'll want to like memorize necessarily. It's just something you'll want to keep doing and keep doing and keep doing, and then you'll finally get it. So don't get frustrated if you're feeling kind of overwhelmed right now. Just keep it up and keep the repetition. Okay, I'm going to take a little break and I'll come back. All right, so a chart of accounts is the listing of all the accounts that we may use that affect the accounting equation. So there's some really fancy numbering schemes that chart of accounts have, and you'll find those if you're going to get more into bookkeeping, but just know that there's a very elaborate chart of accounts that every company has, and they're always different depending on what their numbering scheme is. So examples of asset accounts are like cash, supplies, equipment, accounts receivable, things that are of value to the company. Okay, so are of value to the company. Liabilities are things that I owe. Things that I owe. So I could owe accounts payable. Now what's an accounts payable? Accounts payable is I'm a company, and I go into my office supplies store and I buy a photocopy machine and some paper and some pens and all these other kinds of things, and I say, I'm not going to pay you cash right now, because who wanders around with thousands of dollars in their pocket? No good company would do that. So they say, put it on my tab, right? That's their way of saying, I'm going to put this as a payable. You send me a bill and I'll pay the bill. All right, that's an accounts payable. Salaries payable, any kind of payable is that liability sort of something that I owe somebody else for something that I've consumed, or something that I have, or something that's been given to me, like like somebody working. Those are all liabilities. Okay, stockholders' equity, examples of those are common stock and retained earnings, treasury stock, preferred stock, all these other kinds of things that will go into the equity account, and we'll get into that again. All right. So when we record a transaction, now luckily we know what debits and credits are. This is the standard that we're going to follow. So we're going to put whatever account name. Do you remember that example of like purchasing a piece of equipment? Okay, so we're going to remember the assets are increased with a debit. right? So in this case, we'd put the account name of backhoe, excavator, whatever, a truck, whatever kind of thing we purchased here. Let's just call it equipment for now. $75,000. And we put that under the debit because we're increasing our asset. Got that? Okay, remember we paid cash, so the next account name for us would be cash, and we would credit or decrease our asset by that same $75,000. Okay, so a couple things to remember. We list the debit first, we list the credit second, and then we can put a description down here. In our case, it was purchased equipment for cash. Okay, so that's one example. Now let's pause and think about a different example. We could purchase our equipment by issuing an account payable or a note payable if it was for a longer time, depending on when we were going to pay that off. Okay, so what would that look like? Well, we'd still increase our equipment by that $75,000. That equipment is on our hands, right? So we have that as an asset. But our account name down here, instead of it being cash if we don't pay for cash, would be like accounts payable. And in that case, accounts payable is what kind of an account? Right, it's a liability account. We increase liabilities with a credit, so that would be the $75,000. So that's kind of cool, isn't it? All right, you may want to replay that one a couple of times. I don't know, but hopefully that makes sense. So it doesn't have to be that it's always an increase in an asset and a decrease in an asset. It could be it's an increase in an asset and an increase in a liability, or an increase in a stockholder's equity, or that kind of thing. So I'm just explaining that sometimes it stays on one side of the accounting equation, and sometimes there's an increase in both sides of the accounting equation. But the takeaway on this slide is that your debits must always equal your credits, okay? Always. So I'm going to help you through a couple of examples. On December 1st, Great Adventures, which is my favorite company, sells shares of common stock to investors for $25,000 in cash. So we're going to debit cash for $25,000. Why? Because we're taking cash in, and we're going to credit common stock because when somebody invests in our company, then we're going to issue them stock. That's how that works. So if you purchase something on the New York Stock Exchange, for example, you bought Apple, then you would pay them cash, and then you would get a piece of paper called a stock certificate. Although now that we're in the 21st century, it's all electronic, but pretend like that's what you're getting. And so we're going to increase the common stock. So as Apple, now I'm not thinking about this from the investor side, from Apple's side, they're getting $25,000 because somebody just invested in their company. So you can see that they're going to increase their cash. Remember, cash is an asset, so they increase it with a debit, right? And they also increase their common stock. So they issued some common stock, so they have more common stock outstanding. So they increase the amount of common stock that they've issued. Okay, and common stock is increased with a credit. Don't take my word for it. Actually, go back and check for yourself. Okay, and you'll see that. So, and the good thing is, what's the good thing? The debits equal the credits. So we're in balance. So life is good. Okay, so when we post, we simply take these to their individual accounts and put them in their subledgers. Okay, so let's take a break, and we're going to do exercise 2.8.